In the intricate landscape of business operations in Indonesia, one inevitability that every company, regardless of its size or stature, must come to terms with is the prospect of undergoing a tax audit. These audits are orchestrated by the Directorate General of Taxes, or DGP, as part of their fiscal oversight. Indonesia's taxation framework operates on the principle of self-assessment, which essentially necessitates that taxpayers independently calculate, remit, and report their tax liabilities. Consequently, the DGP possesses the prerogative to conduct tax examinations to ensure compliance with these tax obligations. Given this context, it becomes increasingly paramount for companies to equip themselves with meticulous preparations and implement effective strategies to confront tax audits judiciously. This video elucidates a comprehensive set of tips designed to empower companies in successfully navigating the intricate terrain of tax audits in Indonesia. 1. Profoundly grasp tax procedures, regulations, and the audit process. The foundational step in this journey involves attaining an intimate comprehension of the tax procedures and regulations that govern operations within Indonesia. This encompasses not just a cursory understanding, but a profound familiarity with the pertinent tax regulations, including any recent amendments or modifications. Companies must be well-versed in the specific categories of taxes that are applicable to their operations, such as income tax, PP, and value-added tax, PPN. Furthermore, they must exhibit impeccable knowledge concerning tax reporting mechanisms and adhere religiously to reporting deadlines. It's imperative to underscore the dynamic nature of tax regulations in Indonesia, necessitating an unwavering commitment to staying abreast of any alterations. Another dimension worth exploring is the differentiation between central and regional taxes, as the rules and regulations can diverge at each administrative level. 2. Prepare accurate documentation preemptively before tax audit. In the realm of tax audits, the veracity of documentation serves as the linchpin of defense. Companies must meticulously maintain lucid and comprehensive records of all financial transactions, tax payments, and financial reporting. The sine qua non here is that these documents ought to be easily accessible and impeccably organized. Prudent documentation practices not only facilitate tax compliance, but also expedite the audit process should it become necessary. Additionally, it's imperative that companies ensure all invoices, receipts, and ancillary documents pertaining to financial transactions are diligently safeguarded. Regularly scheduled electronic data backups are recommended to mitigate the risk of critical data loss. 3. Meticulous cash management is key. Flawless cash management assumes critical importance when embarking on the arduous journey of a tax audit. Companies must exhibit the ability to incontrovertibly trace the sources and applications of funds. The inflow and outflow of funds must be meticulously recorded, and funds should be deployed in strict adherence to their earmarked purposes. Shoddy cash management practices can arouse suspicion and raise red flags during an audit. 4. The importance of not overlooking employee income tax. Employee income tax, or PP21, constitutes a pivotal obligation for companies, involving the precise calculation, deduction, and timely remittance of taxes on employee incomes. One common pitfall to evade is negligence in correctly executing the deduction and remittance of PP21. The DGP maintains a vigilant watch over a company's adherence to these stipulations. To ensure robust compliance, companies should undertake a meticulous study of the PP21 tariff table and diligently adhere to the prescribed deduction rates. 5. The value of seeking counsel from tax professionals. Navigating the labyrinthine corridors of a tax audit is a formidable task. In this context, it is highly advisable to consider enlisting the expertise of licensed tax professionals. These seasoned experts can serve as invaluable allies, elucidating the labyrinthine nuances of tax regulations and pinpointing potential pitfalls. They are also well equipped to aid in the meticulous preparation of audit documentation, manage communication with the DJP, and dispense invaluable tax counsel. Tax professionals can also play a pivotal role in optimizing tax planning strategies to legally alleviate the tax burden. 6. Undertake preemptive internal audits. Preempting a DJP audit, companies can proactively conduct internal audits. This proactive measure aims to identify latent issues and rectify discrepancies within financial records before the DJP launches its external audit. Internal audits, if conducted diligently, can evolve into an efficacious instrument for enhancing operational efficiency. 7. Maintain transparent communication with the DJP. During the audit process, fostering transparent and constructive communication with the DJP is indispensable. Timely and comprehensive responses are expected, and complete cooperation is pivotal. In the event of any ambiguities or shifts in the company's tax landscape, immediate reporting to the DJP is imperative. Keeping meticulous records of all communications with the DJP stands as a prudent practice for future reference. 8. Assemble a specialized audit team. Preparing to face a tax audit is a collective endeavor. Establishing a dedicated team tasked with managing the audit process and coordinating internal efforts is recommended. This specialized team should comprise individuals endowed with an intimate understanding of tax regulations and possess effective communication skills for interfacing with the DJP. Provide training and allocate necessary resources to fortify your internal audit team. Thoroughly evaluate audit outcomes. Upon the conclusion of the audit, a meticulous evaluation of the outcomes is imperative. In the event that errors or discrepancies surface, swift and effective rectification is warranted. By adhering to these meticulously curated tips, companies can confront tax audits with confidence and mitigate potential risks. Tax audits may present formidable challenges, yet with meticulous preparation, companies can guarantee compliance with tax regulations and maintain the seamless continuity of their operations. Staying abreast of the ever-evolving tax regulations and preserving precise documentation are the cornerstones of charting a prosperous course in Indonesia's dynamic business landscape. This is the end of the video. Don't forget to like and subscribe so you won't miss out our content. Thanks for watching, and we'll see you in the next video. Bye-bye.